When RC drops below 30, most amateurs see one thing: opportunity. Professionals see something completely different: danger. That tiny number at the bottom of your chart might be the most expensive number on your entire screen, not because of what it tells you, but because of what it tempts you to do. Here's the brutal truth that quietly drains trading accounts every single day. More traders blow up buying the dip on oversold RSI than chasing momentum at the top. Everyone mocks FOMO buyers at all-time highs, but the graveyard is full of traders who thought they were being smart and contrarian because RSI flashed 28 and the stock looked cheap. You probably know this script already because you've lived some version of it. It usually starts with a stock you love. Maybe it's a big tech name or a high-flying growth stock. It's been climbing for months, and you felt like you missed the boat. Then the market turns. The stock drops 10%, then 20%. You pull up your chart and look at the RSI indicator. It's sitting at 28. Your brain immediately screams bargain. You tell yourself the selling is overdone. You tell yourself it cannot possibly go lower. So you buy. You take 500 shares because you're terrified the price will snap back up and leave you behind again. For a few hours, maybe even a day, you feel clever. The stock bounces slightly from 65 to 67, but then the selling resumes. The stock drops to $60. You look at RSI again. Now it's at 24. This is the moment where the amateur makes the fatal mistake. Instead of admitting they were wrong, they double down. They think if it was a buy at 28, it's a screaming buy at 24. They add another 500 shares. They average down. They let their ego drive the trade because they need to be right more than they need to make money. 2 days later, the stock gaps down to $55. Now you're down 18% on a double-sized position. You're trapped in a falling knife, watching cheap become cheaper, paralyzed by fear, hoping for a bounce that isn't coming. This is the dip buyer's death spiral. Each decision felt logical in isolation. Each RC reading seemed to confirm your thesis. But you violated the cardinal rule. You increased risk as the trade moved against you. You threw good money after bad. You confused a technical indicator with a crystal ball. An amateur uses RC below 30 as permission to abandon risk management. They tell themselves, it's already so oversold, the risk is limited. That sentence has probably cost more capital than any obvious mistake, because it feels logical. It feels intelligent. A professional uses RC below 30 as a warning to tighten rules and shrink size. They don't see a bargain. They see a fire alarm. Jesse Livermore didn't have RSI on his tape, but he understood this principle before the indicator even existed. In the panic of 1907, he watched Union Pacific crash from 180 to 120. Every tick down, the crowd on the floor screamed oversold. They'd say, it's down 30%, it has to bounce. So they bought. And it bounced. For a day, maybe two. Then it rolled over and made new lows. Livermore himself took a position at 140, convinced the worst was over. He kept to 115 before cutting his loss. But the crowd kept buying every dip. That stock eventually washed out at 90. Think about that math. If you bought the oversold up at 120, thinking you were getting a steal, you still lost another 25% before the bottom was in. The dip buyers were carried out on stretchers, bankrupt and broken. Years later, Livermore would say that losing trade taught him more than any winner ever did. It taught him that oversold can always become more oversold. It taught him that when a stock is crashing, there's no such thing as too low. Here's what most people don't understand about RSI. It's not measuring value. It's not measuring intrinsic worth. It's measuring momentum. It's measuring the velocity of price change over 14 periods. When RSI drops below 30, it's telling you that selling pressure is extreme. But extreme can become more extreme. Think of it like a car accelerating downhill. RSI tells you the car is going fast. It doesn't tell you when the brakes will work. The amateur sees RSI at 28 and thinks, this is the bottom. The professional sees RSI at 28 and thinks, the selling is violent, I need to wait for it to stop before I do anything. That difference in interpretation is the difference between survival and ruin. Let me give you a modern example. In 2008, Lehman Brothers dropped from 60 to 40 in a matter of weeks. RSI plunged below 30. Seasoned traders who knew better started nibbling. They thought they were buying value. The stock went to 20, then 10. Then 0. Every level looked like a bargain compared to where it had been. Every RC reading looked oversold. But the selling never stopped until the company ceased to exist. When you see RSI hitting 25 or 20, you're not looking at a discount bin. You're looking at a stampede. The smart money isn't buying yet. If the institutions thought that price was a bargain, they would step in with such force that the price would reverse instantly. The fact that the stock keeps making new lows while RSI is oversold tells you that big money is either selling or standing aside. And if they're standing aside, you have no business stepping in front of the train. Here's what separates winners from losers. Amateurs buy weakness hoping for strength. Professionals buy strength after weakness ends. That single distinction will save you more capital than any indicator ever will. The amateur wants to be the hero who catches the exact bottom. The professional wants to be the trader who enters when the odds are clearly in their favor. So when you see RSI drop below 30, your first instinct should not be to reach for the buy button. Your first instinct should be to put that stock on a watch list and wait. Wait for confirmation that the selling has actually stopped. Wait for signs that buyers are stepping in with conviction. Wait for the stock to prove it can hold a level and build a base. Professional traders build rules around that difference. They don't see RSI 28 and hit buy. They see RSI 28 and move the stock from ignore to observe. It goes on a watch list. The question shifts from is this oversold to has the character of this selling changed yet? In this video, you'll discover the 3 confirmation protocol that professionals demand before risking a single dollar on oversold readings. We're going to move you from guessing to executing. You'll learn why the first touch of RSI 30 is almost always a trap designed to suck in impatient capital. Think of that first oversold reading like the first crack in a dam. It's not the end of the pressure. It's the beginning of visible damage. You'll see the position sizing formula that turns potential disasters into manageable risks. Because even when you're right about direction, you can still lose if your sizing is wrong. We'll show you how professionals trade small into uncertainty and only scale when the tape confirms their idea. Most importantly, you'll learn to respect duration. How long has RSI been under 30? Did it tag 29 once and bounce? Or has it sat between 20 and 30 for 10 sessions straight? Those are not the same conditions. The crowd treats them as identical. The professional does not. By the end, you'll stop asking, is RSI oversold? That's the beginner's question. You'll start asking, has the selling pressure actually stopped? That's the professional's question. Because buying the dip correctly isn't about catching bottoms. It's about surviving the bottoming process, so you have capital left when the real move begins. In the next chapter, we're going to dissect exactly why oversold so often becomes more oversold and how that cycle pulls amateurs deeper every time they try to fix their first mistake. Once you see that trap in slow motion, RSI below 30 will never look the same to you again. Let me show you the mechanical reason dip buying destroys accounts, step by painful step. This is the trap that feels intelligent while it's destroying you. You're watching a stock that's been sliding. It drops from 80 to 70 over 2 weeks. You pull up your chart and see RSI sitting at 29. Your brain immediately thinks, this is oversold. This is my entry. You buy 100 shares at $70. Your cost basis is clean. Your risk feels contained because the indicator is flashing that magic oversold signal. 2 days later, the stock drops to 68.U. Redown 200. You check RSI again. Now it's at 25. Here's where your brain does something dangerous. It doesn't say I was wrong. It says if 29 was oversold, then 25 is screaming oversold. The stock is even cheaper now. So you double down and add 200 shares at $68. Let's do the math on your position. You own 100 shares at 70 and 200 shares at 68. That's 300 shares total. Your average cost is 68.67. The calculation, frac 100 times 70, plus 200 $300 plus 13,600 300 plus 68.67. You're down about 5% on your total position roughly. 1,000 if we. Re-talking about a 20,000 account. It stings, but you tell yourself it's temporary. You tell yourself the bounce is coming any day. 3 days pass. The stock gaps down on earnings too. 64 RSI is 22.U. RE now sitting on 300 shares with an average cost of 68.67, and the current price is 64.U. RE down 1,400. That's a 7% loss on your total capital. And here's where the trap closes completely. You're frozen. You can't add more shares because you're already overexposed, and the fear is gripping your chest. You can't sell because the loss feels too big, and your ego won't let you admit defeat. So you just sit there and bleed, watching the position deteriorate, praying for a miracle bounce that isn't coming. This is the dip buyer's death spiral. Each decision felt logical when you made it. Each RSI reading seemed to confirm your thesis that the stock was getting oversold and due for a reversal. But you violated the cardinal rule of speculation. You increased risk as the trade moved against you. You threw good money after bad. Jesse Livermore called this the most dangerous habit in speculation. He said the desire to average losing trades has probably cost more money than any other mistake in the history of Wall Street. Early in his career, Livermore would take a position, watch it go against him, and then add more, because he was convinced the market was wrong, and he was right. That thinking cost him his first fortune. It took years for him to learn that when the market disagrees with you, the market is right, and you are wrong. Period. The tape doesn't care about your opinion. The tape doesn't care that RSI is at 22. The tape is telling you that sellers are in control, and you're fighting a battle you cannot win. Here's what amateurs completely miss about this dynamic. When a stock gives you multiple comfortable chances to buy it cheaper over days or weeks, professional money isn't accumulating yet. Think about the logic of supply and demand. If a stock is truly undervalued at $70, if it's truly a screaming buy, big institutions don't wait around. They step in aggressively. They sweep the order book. When real institutional buying hits a stock, the price reverses violently and quickly. True bottoms happen fast. They don't give you 3 comfortable days to casually add shares at better prices. The fact that you can keep averaging down at 68 and 64 tells you something critical. The smart money isn't buying yet. You are providing liquidity for the institutions who are exiting. You are catching the falling knife that the professionals stepped aside to let fall. Let me give you a real example from 2022. Meta Platforms dropped from 230 to 180 in a matter of weeks. RSI dropped below 30. Retail traders started buying, convinced it was oversold. The stock went to 150. More buying as RSI hit 25. The stock went to 120. People were calling it the buy of the decade at 120. The stock eventually bottomed at 88. Every single person who bought the oversold dip between 180 and 120 was underwater for months. The comfortable averaging down was the trap. If Meta was truly bottoming at $180, it wouldn't have given you weeks to add at lower prices. Now let's talk about what RSI actually measures, because this is where the fundamental misunderstanding starts. RSI is not measuring value. It's not telling you whether a stock is cheap or expensive. EC measures the velocity of price change over 14 periods. When EC is at 25, it's telling you that selling velocity is extreme relative to recent history. But here's the critical insight. Velocity can accelerate. Think of it like a massive tanker ship steaming downhill. EC tells you the ship is going 60 miles per hour. That's fast. But it doesn't tell you whether the captain has hit the brakes yet. It doesn't tell you whether the slope gets steeper ahead. RC can drop from 25 to 15, while the stock loses another 20% of its value. You're not buying value when you see RSI at 25. You're stepping in front of a freight train and hoping physics doesn't apply to you. The professional approach to RSI below 30 is radically different. When a professional sees RSI cross under 30 for the first time, they do absolutely nothing. They don't buy. They don't even put the stock on their buy list. They simply move that stock from their ignore list to their observation list. That first breach of 30 is an alert, not a signal. It's the market raising a yellow flag saying, pay attention, we're reaching extremes. Nothing more. This is the hardest skill you will ever learn as a trader. Waiting is a position. Cash is a position. Doing nothing while you wait for confirmation is an active trading decision, not a passive one. The amateur feels like they're missing out if they're not in a trade. They feel like the market is leaving them behind. The professional knows that preservation of capital is more important than participation in every move. When RSI first drops below 30, the professional asks completely different questions. They ask, how long has this been going on? Is this the first touch of 30, or has RSI been bouncing between 20 and 35 for 2 weeks? They ask, what does volume look like on the down days versus the bounce attempts? They ask, where are the pivotal price levels? Is there clear support nearby, or is this stock in free fall? Most importantly, they ask, what would have to happen for me to believe the selling pressure has actually stopped? They define their conditions in advance. They don't wing it. They don't hope. They wait for the market to prove that the character of the decline has changed. Here's a scenario that plays out constantly. Stock drops from 50 to 42. RSI hits 28. Amateur buys immediately. Stock bounces to 44, and the amateur feels vindicated for days. Then the stock rolls over and drops to 38. RSI hits 24. The amateur adds more, convinced they're getting an even better deal. Stock bounces to 40. Temporary relief. Then it drops to 34. The amateur is now trapped in a position that's down 20% and still falling. The professional watched that entire sequence from the sidelines. They saw RSI hit 28 and did nothing. They saw the bounce to 44 and did nothing. They saw the drop to 38 and still did nothing. They're waiting for something specific. They're waiting for the stock to prove it can hold a level and build a base. They're waiting for volume to dry up on the sell-offs. They're waiting for RSI to not just touch 30, but to reclaim higher levels and show that momentum is actually shifting. That patience feels painful in the moment. It feels like you're missing the opportunity. But that patience is the edge. Because while the amateur is bleeding capital on a falling knife, the professional still has their powder dry, ready to deploy when the actual setup appears. In the next chapter, I'm going to show you exactly what the professional is waiting for. The 3 specific conditions that must all be present before they'll risk a single dollar on any oversold reading. These aren't vague concepts. They're concrete, observable signals that you can identify on any chart. And once you understand them, you'll never look at RSI below 30 the same way again. RSI below 30 is not your entry signal. It never has been, and it never will be. It is your watch list filter. That single shift in perspective will save you more capital than any other concept in this video. When RSI drops under 30, you do not see opportunity. You see a yellow flag. You put that stock on a specific list, and you wait. You are now hunting for 3 very specific things. All 3 must appear before you risk a single dollar. Miss one, and you are gambling on hope. Hit all 3, and your odds shift dramatically from guessing to probability. This is the 3 confirmation protocol. It is the gatekeeper between amateur speculation and professional execution. Most traders lose money not because they lack knowledge, but because they cannot wait for their complete setup. They see 2 out of 3 signals and convince themselves it is good enough. It is never good enough. The stock must stop making lower lows. This sounds simple, but understanding what it actually tells you separates professionals from everyone else. When a stock is in a downtrend, it makes a series of lower lows. Each sell-off pushes to a new low point. That pattern tells you sellers are in complete control, pressing their advantage with every bounce. A higher low changes that dynamic fundamentally. Let's walk through this step by step. A stock drops from 60 to 40 over 3 weeks. That 40 level represents capitulation, panic, forced selling, not the stock-bound chest of 42 on short covering and relief buying. This is where amateurs make their fatal mistake. They see green candles after a brutal decline and think the bottom is in. They buy at $42, convinced they are getting a bargain. The professional does something completely different. They wait for the second test. They wait to see what happens when that 40 level gets challenged again. The stock rolls over from 42 and starts drifting lower. It drops to 41. Here is the moment of truth. If buyers step in at 41 and refuse to let the stock touch 40 again, you have a higher low. That 41 level tells you sellers have lost control. The selling pressure that crushed the stock from 60 to 40 is no longer strong enough to make new lows. But you cannot know this on the first bounce. You can only know it on the retest. The first bounce could be short covering, technical relief, or dead cat bounce. The second test reveals whether real demand is stepping in. If the stock slices through. 40 on the pullback. This setup is dead and just saved your capital. If it holds 41, you have your first confirmation. Think of this like a military battle. The first counterattack might succeed temporarily, but it doesn't mean the enemy is retreating. The second test tells you whether your side can hold the ground they took. If they hold it, momentum is shifting. If they cannot hold it, the dominant trend remains intact. Volume tells you about conviction and exhaustion. High volume means strong conviction. Low volume can mean weak conviction or, more importantly in our context, seller exhaustion. When the stock drops from 42 back to 41 on that retest, you must examine the volume bars closely. On the initial crash from 60 to 40, volume was likely massive. Panic selling, capitulation, margin calls, institutional liquidation. That heavy volume represented genuine fear and forced selling. On the bounce to $42, volume might be decent as shorts cover and bargain hunters emerge. But on that drift back down to $41, you want to see volume dry up completely. You want narrow, quiet volume bars. Why? Because low volume on a pullback means sellers are exhausted. The panic is gone. The people who wanted to sell at any price have already sold. The urgency has evaporated. If the stock drops from 42 to 41 on volume that matches or exceeds the prior decline, that is a screaming red flag. It means new sellers are entering the market. Fresh supply is hitting the tape. The decline is not over, it is just pausing before the next leg down. When you see expanding volume on a retest of support, you walk away immediately. But if the stock drifts to $41 on light, whisper quiet volume, it tells you the selling pressure has evaporated. The emotional flush is complete. The path of least resistance is about to flip from down to up. That volume pattern is your evidence that the character of the decline has fundamentally changed. Here is the rule that confuses most people. They ask, why would I wait for RSI to climb back to 40? Isn't the whole point to buy when it's oversold below 30? The answer reveals the difference between hoping for a reversal and confirming one has begun. When RSI is at 25, the stock is in freefall. Momentum is violently negative. You have no idea where the bottom is or when the selling will exhaust itself. When RSI climbs back above 40 after being under 30, it is mathematical confirmation that momentum has shifted from bearish to bullish. Think about what RSI above 40 means mechanically. It means that over the last 14 periods, gains are starting to outweigh losses. The average up day is becoming stronger than the average down day. The stock is no longer in pure liquidation mode. It is building a base and showing that buyers have stepped in with enough force to change the trajectory. Jesse Livermore did not have RSI on his tape in 1907, but he understood this principle perfectly. He would wait for the first sign of strength after prolonged weakness. He would not try to catch the exact bottom. He would wait for the stock to prove it could rally and hold gains. That is exactly what RSI reclaiming 40 gives you. It is the mathematical equivalent of the tape turning. When you buy at RSI 25, you are hoping the decline will stop. When you buy at RSI 42, you are reacting to evidence that the decline has already stopped. Hope versus evidence. That is the difference between gambling and trading. Let's walk through a detailed example with all three confirmations present. A stock drops from 60 to 48 over 3 weeks. RSI hits 26 on that final washout. Every social media feed you follow is screaming oversold. You do nothing. You watch. From 48, the stock rips to 52 in 3 days on heavy volume. It trades 8 million shares versus its usual 3 million. RSI climbs from 26 to 38. This is where most traders hit buy. Strong bounce, big volume, RSI rising. But you know better. You know you need to see how it behaves on the pullback. The stock then drifts down from 52 to 50 over 4 sessions. Volume shrinks to 3.5 million shares, slightly above average but far below the panic selling and rebound volume. RSI dips from 38 to 35 but crucially stays above 30. You mark that. 50 level is your potential higher low. If it breaks 48, the whole structure fails, and you move on. No emotion, no attachment. From 50 buyer stepping again. The stock pushes stove 51 then. 52 then 53. Volume starts expanding on the up days. RSI finally crosses 41 and holds above 40. Now you examine your checklist. Did price make a higher low? Yes. 48 was initial low. 50 held on the retest. Did volume shrink on the pullback from 52 to 50? Yes, selling volume was noticeably lower than the panic leg down. Did RSI reclaim 40 after living below 30? Yes, it went from 26 to 38, held 35 on the pullback, then punched through 40 and held. All three confirmations are present. Now and only now do you test a small position. You buy 200 shares at 53 with a stop loss just under 50. Your risk per share is 3. Your total risk is 600. If you are working with a $50,000 account, that represents 1.2% risk. That is manageable. That is professional. Contrast this with the amateur approach. The amateur sees RSI at 26 and buys 500 shares at 48, convinced he's getting a steal. The stock bounced up 52, and he feels like a genius for 2 days. Then it drops back to 48 and highs break even. Then it drops to 46, and he is down 1,000. Highs go kicks in. Heads 500 more shares to average down. Convinced the market is wrong. Now owns 1,000 shares with an average cost of 47. The stock drops to 44. Highs down 3,000 and frozen. He cannot add more because he is already overexposed and fear is gripping his chest. He cannot sell because the loss feels too big and his ego will not let him admit defeat. Meanwhile, the professional is still sitting in cash, waiting patiently for all three confirmations. When the stock finally bottoms at 44 and starts the real reversal, the amateur is too traumatized and overleveraged to participate. The professional sees all three confirmations at 53 and enters fresh with a clear stop and proper sizing. Same stock, same opportunity, completely different outcomes. This system works because it stacks probabilities in your favor. Any single signal can fail. A higher low can break. Volume can dry up temporarily before another wave of selling. RSI can reclaim 40 and then roll over. But when all three appear together, when price structure, volume behavior, and momentum indicators all align, your odds of catching a sustainable move increase dramatically. You are not trying to predict what will happen next. You are recognizing what is happening now. You are forcing the market to show its hand before you place your bet. Most traders are desperate to be first, to catch the absolute bottom tick for bragging rights. Professional traders do not care about being first. They care about being right and keeping their drawdowns small. That patience is the ultimate edge. While others are catching falling knives and bleeding capital, you are waiting for confirmation that the knife has hit the ground and stopped bouncing. In the next chapter, we are going to address the one thing that can still destroy you even if you execute this entry protocol perfectly: position sizing. Because finding the right setup is only half the battle. How much you bet on that setup determines whether you survive the inevitable false signals and live to profit from the winners. You found all three confirmations. RSI reclaimed 40. Price made a higher low. Volume dried up on the pullback. You have done the hardest part. You waited. The setup is clean. The signals are aligned. You are ready to buy. And this is the exact moment where most traders, even those disciplined enough to wait for proper confirmation, quietly destroy themselves with a single fatal mistake. They bet too big on the first test. Position sizing is the forgotten edge in trading. Everyone obsesses over entry signals and exit strategies. Everyone wants to decode the perfect RSI settings or discover the magical support level. But position sizing determines whether you survive long enough to let your statistical edge play out over hundreds of trades. Get the entry perfect, but the sizing wrong, and you will still blow up your account. Get the entry mediocre, but the sizing right, and you can build wealth systematically over time. Jesse Livermore understood this brutal truth only after losing multiple fortunes early in his career. He said it's not the thinking that makes money, it's the sitting. That quote gets repeated endlessly in trading circles, but most people miss the critical prerequisite hidden within it. Before you can sit on a winning position and let it compound, you need to survive the initial test. Survival depends entirely on one factor: position size. Here is the rule that separates professionals from everyone else. Never risk more than 1 to 2% of your total account equity on the first entry into any oversold bounce. Not 5%. Not 10%. Certainly not the 20% or 30% that desperate amateurs throw at their sure thing setups. 1 to 2% maximum. This sounds absurdly conservative to the trader who has been waiting weeks for this perfect setup to appear, but there is cold, mathematical logic behind this constraint. Even with perfect confirmation signals, even when all three of your conditions align beautifully, the stock can still fail. The market does not reward you for patience. The market does not care that you did your homework and waited for confirmation. Sometimes your perfect technical setup gets steamrolled by forces you cannot see. A surprise earnings disappointment, an algorithm liquidating a massive position, or broader market selling that overwhelms individual stock technicals. Professional traders expect this. They size their positions assuming they might be wrong, even when everything looks right. Amateur traders size their positions assuming they will be right, because they cannot psychologically accept that their careful analysis might fail. When all three confirmations appear, you do not take a full position. You take what professionals call a pilot position. Think of it as a military scout sent ahead of the main force. If the scout encounters an ambush, you lose one soldier, not the entire battalion. You are testing the market's commitment to your thesis with a small amount of capital. Let's make this concrete with precise numbers. Your trading account is 50,000. Use risk 1,500. That $500 represents your maximum acceptable loss on this position. Not your position size, but your maximum loss if your stop gets hit. The stock is trading at 52 after reclaiming RSI 40. You have identified 50 as your stop loss level, positioned just below the higher low that formed during the pullback. This gives you $2 of risk per share. To calculate your position size, you divide your dollar risk by your per share risk. Position size. Risk per share. Total risk. Total 2. 500. Con 50 shares. You buy exactly 250 shares at 52. Not 500 shares because you have more buying power. Not 1,000 shares because you feel really good about the setup. You buy 250 shares because precisely $500, which is precisely 1% of your account. The mathematics are clean. The risk is defined. Your emotions can remain calm because you know exactly what you stand to lose. Contrast this disciplined approach with how the amateur handles the same setup. The amateur sees all three confirmations and thinks this is it. This is the big one that will make up for last month's losses. He looks at his 50,000 account and calculates that could afford 900 or even 1,000 share set 52. He is thinking about position size in terms of buying power, not risk management. That perspective shift is the difference between survival and ruin. He buys 1,000 shares at 52, committing 52,000 to the position. The stock trades sideways for a day, then drops 2% to 50.96 highs, no down 1,040 on paper, which represents more than 2% of his total account on a single trade. His chest tightens, his palms sweat. He refreshes his trading platform every 30 seconds. The position has become emotional, and emotional positions cloud judgment. The stock continues to wiggle, dropping another 1% to 50.45, now highs down 1,550. His original stop was supposed to be at $50, but he cannot bring himself to sell because the loss feels catastrophic. His ego kicks in with dangerous rationalizations. It's just temporary weakness. The setup is still valid. I'll give it more room. He holds, hoping for salvation. The stock drops to 49. No highs, down 3,000, which represents 6% of his account on a single trade. He is completely paralyzed. He cannot add more shares because he is already terrifyingly overexposed. He cannot sell because the loss has become so large that admitting defeat feels impossible. So he sits there, frozen, watching his capital evaporate while stress hormones flood his system. Meanwhile, the professional who bought 250 shares at 52 watched the stock at this step at 50, cut the position immediately for a $500 loss, and moved on to analyze the next potential setup. The sting lasted about 5 minutes. His capital preservation allowed him to stay in the game. Here is where position sizing transforms from defensive tool to offensive weapon. That initial 250 share position is not your final position. It is your test. If the stock proves itself by holding the higher low and building momentum, then and only then do you add to the position. This strategy is called pyramiding, and it represents the exact opposite of the amateur's instinct to average down into weakness. Let's walk through a complete scenario to illustrate the mathematics and psychology. You bought 200 shares at 52 with Astapat 50. Your initial risk is 400. The stock consolidates between 51 and 53 for 3 days, building a Bayesian demonstrating that buyers are willing to defend the level. Then it breaks above 54 on expanding volume with RSI climbing toward 45. This breakout represents your signal to add to initial position. You add 150 shares at 54.50. Wynatano represents your stomach, your initial position. You scaling gradually as the market proves that this is correct, which represents the breakout level. If the stock fails and drops back below $52, both the original and additional positions will be stopped out. Let's calculate your average cost across the combined position. Average cost tech 350, 2052 plus 5450, 350, 10,400 plus 8,175, 5307. Your average cost is $53.07 per share on 350 total shares. Notice something critical about this structure. You added at a higher price than your initial. You pyramided into strength, increasing your position size after the market confirmed your thesis, not before. This represents the exact opposite of what the amateur does when he averages down into weakness. Now let's examine 2 possible outcomes to understand the risk-reward profile you have created. Failure scenario. The stock rallies to 56. Then fails and drops back to your 52 stop level. You exit both positions at 52. Your original 200 shares break-in, 52 entry. 52 exit. Your additional 150 share slows, 2.50 each, for a total loss of 375. Combined with transaction costs, your total loss is approximately 400, which represents less than 1% of your $50,000 account. The loss stings, but it does not damage your capital base or emotional state. Success scenario. The stock continues its move higher to 62. You exit both positions at 62. Your original 200 shares gained, 10 each, 52 62, generating 2,000 in profit. Your additional 150 shares gained, 7.50 each, 54.52 62, generating 1,125 in profit. Your total profit is 3,125 on a maximum risk that never exceeded 775. This represents a risk-to-reward ratio of approximately 4:1. The mathematics reveal the power of this approach. You risked less than 2% of your account to potentially make more than 6%. More importantly, you structured the trade so that your risk actually decreased as your position size increased, because you were pyramiding into a move that was already working in your favor. The emotional freedom of small size. Position sizing provides something more valuable than mathematical optimization: emotional freedom. When you risk 1% on a trade, you can execute your stop loss without hesitation if the setup fails. The loss does not threaten your account. It does not wound your ego. You can think clearly, evaluate the chart objectively, and make rational decisions based on what the market is telling you. When you risk 10% or 20% on a trade, you lose the ability to think rationally. The position becomes too important to your financial and emotional well-being. You start hoping instead of trading. You start praying instead of executing your plan. You hold losers too long because the pain of realizing the loss feels unbearable. You cut winners too early because you become desperate to lock in any profit after experiencing the fear that comes with large positions. Large position sizes turn disciplined traders into emotional wrecks. Small position sizes preserve the mental clarity necessary to execute your edge consistently over hundreds of trades. That emotional control represents the real competitive advantage, not the specific indicator settings or chart patterns you trade. The mathematical edge of survival. Consider the mathematics of survival from a purely statistical perspective. If you risk 1% per trade, you can be wrong 50 times in a row before you lose 50% of your account. That gives you an enormous margin for error and the psychological resilience to continue executing your system even during inevitable losing streaks. If you risk 10% per trade, just 5 consecutive losses puts you down 40%. Now you need a 67% return just to reach break even. You have dug yourself into a mathematical hole that is extremely difficult to escape, and your psychology is completely shattered. The fear of another large loss will cause you to either stop trading entirely or reduce your position sizes to ineffective levels. Professional traders understand that their edge is not their ability to predict what the market will do next. Their edge is their ability to manage risk so effectively that they survive long enough for probabilities to work in their favor over a large sample of trades. The best entry signal in the world becomes worthless if you bet so aggressively that a single failure cripples your account. The complete protocol in practice. Here is your complete position sizing protocol for oversold bounces. When IC reclaims 40 after forming a higher low on declining volume, you calculate your risk first, not your position size. Determine your stop-loss level. Calculate the dollar amount you are willing to lose, 1% of account equity. Divide your dollar risk by your per-share risk to determine your exact position size. Enter with that pilot position and monitor how the stock behaves. If it immediately violates your stop, exit without hesitation. The small loss preserves your capital for the next opportunity. If it consolidates and then breaks higher on volume, consider adding to the position using the same risk management principles. Never let your total risk on any single trade exceed 2% of your account, even after pyramiding. Most importantly, treat each position as one trade in a series of hundreds you will take over your career. The outcome of any individual trade is meaningless. What matters is that you execute your risk management system consistently, allowing your statistical edge to compound over time. This discipline, this mathematical approach to risk, is what enables you to sit on winners and let them run. When you know that even total failure will cost you less than 2% of your capital, you can hold through temporary weakness and give your winners room to develop into significant profits. The amateur wants to hit home runs on every swing. The professional wants to get on base consistently and let the occasional home run take care of itself. Position sizing is what transforms you from a gambler hoping for the big score into a systematic trader building wealth through disciplined execution. In the next chapter, we will explore the ultimate trading position, doing absolutely nothing. Because sometimes the most profitable trade you can make is the one you do not take. Patience is not just a virtue in trading, it is a position that pays dividends when deployed correctly. Here's the rule that separates professionals from everyone else. The principle that took Jesse Livermore decades and multiple fortunes to learn: doing nothing is sometimes the best trade you will ever make. When RSI drops below 30 and you do not see all three confirmations, your position is cash. Most traders think cash means waiting to take a position. They are wrong. Cash is a position. It is the position of patience. It is the position of power. It is the position that pays dividends every time it prevents you from taking a bad trade. The amateur's anxiety versus the professional's peace. The amateur feels a constant, gnawing anxiety when he is not in a trade. He watches his screen, sees RSI at 27, and his brain screams, "I have to do something." The market is moving. Other traders are posting wins on social media. He feels left behind, irrelevant, like he is not working if he is not clicking buttons. So he forces a trade where none exists. He invents reasons to buy. He hallucinates confirmations that are not there. The professional sees RSI at 27 and thinks two simple words: "I'll wait." He feels no pressure whatsoever. He knows a fundamental truth that the amateur has never internalized. Missing a trade costs you $0. Not a penny leaves your account when you watch a stock move without you. But taking a bad trade costs everything. It costs capital. It costs emotional energy. It costs the confidence necessary to execute your next setup correctly. The professional guards his capital like a fortress. He only lowers the drawbridge when the friendly army of probability arrives at his gate with all three confirmations in hand. The mathematics of selectivity. Let's examine this principle through cold, unforgiving mathematics. Because emotions lie, but numbers reveal truth. Assume you have identified a system that wins 70% of the time when you wait for complete confirmation. Over 3 months, you take 10 high-probability trades. 7 win, 3 lose. With an average winner of 1,000 and average Losera 400, your results look like this. Selective approach profit, Slux 71,000, 3,400, 7,000 ILs, 200, 5,800. Now consider the alternative, where you cannot tolerate waiting. You take 20 trades over the same period, forcing entries when only partial confirmation exists because you feel compelled to participate. Your win rate drops to 40% due to lower probability setups. 8 trades win, 12 lose. Hyperactive approach profit, sex, 81,000, 12-4, 8,000, 4,800, 3,200. The mathematics are brutal. The selective trader makes 81% more profit despite taking half as many trades. More trades do not equal more profit. Better trades equal more profit. Better trades come exclusively from waiting for your exact setup, every element aligned, no compromises accepted. The complete case study, patience in action. Let me walk you through a detailed scenario that illustrates how patience transforms both outcomes and experience. A stock drops from 70 to 55 over 3 weeks on heavy selling. RSI crashes to 24. Every social media feed screams oversold. Technical indicators flash buy signals. The crowd sees opportunity. The amateur's journey, he sees RSI at 24 and cannot resist. He buys 500 shares at 55, committing 27,500 to the position. The stock bounces to 57 the next day and feels vindicated. Then reality hits. The stock rolls over. Drops to 54 then. 52 bought RSI plunges to 19. Highs down 1,100 and stressed. 3 weeks pass with the stock chopping between 52 and 56. He is underwater, checking his phone every 30 minutes, unable to focus on work or family. His capital is trapped. His emotions are shredded. The professional's journey, he sees the drop to 55 and RSI at 24. He does nothing except add the stock to his watch list. Zero stress. Zero risk. The stock bounces to 58 over 2 days. RSI climbs from 24 to 36. He notes the bounce but sees no higher low yet, so he continues watching. The stock pulls back from 58 to 56 over 3 days on noticeably lighter volume. RSI dips to 33, but stays above 30. He marks this as potentially significant, but still does not enter. From 56, the stock builds momentum. It pushes to 59 over the next week. Volume expands on up days. RSI crosses 42 and holds above 40. Now he reviews his checklist. Price made a higher low? Yes. The 55 low held at 56 on the retest. Volume dried up on pullback? Yes. The decline from 58 to 56 occurred on 40% less volume than the crash. RSI reclaimed 40? Yes. From 24 to 36 held 33, now at 42. All 3 confirmations present. He buys 300 shares at 59 with Astapat 56. Risk per share, 3-point total risk 900 representing 1.8% of his 50,000 account. The stock runs to 68 over 2 weeks. He exits for $2,700 profit. Comparing the experiences, the amateur was at risk for 5 weeks, stressed for 3 of them with his capital tied up in a dead. The professional watched for 3 weeks with zero stress, then was only at risk for 2 profitable weeks. Both made money, but the professional did it with a fraction of the emotional cost and time exposure. The hidden cost. Emotional capital. Every trade you take costs something, invisible, but real, emotional capital. When you force trades without proper confirmation, you enter in a state of uncertainty. You know the setup is not quite right. That knowledge creates anxiety. You watch obsessively. You second-guess your entry. You cut winners too early from desperation and hold losers too long from ego. The professional who waits for complete confirmation enters with conviction. When the position moves against him, he cuts without emotional turmoil because he executed his system correctly. When it moves favorably, he can hold through volatility because his entry was based on evidence, not hope. The Livermore transformation. Jesse Livermore went broke multiple times early in his career for one reason: he could not sit still. He was brilliant at reading the tape and understanding market psychology, but he overtraded. He forced positions when setups were incomplete. He could not tolerate watching the market move without him. The turning point came when he finally learned that patience is a position. He began going weeks, sometimes months, without taking a single trade. He would watch dozens of stocks, studying their behavior, waiting for perfect alignment. When that moment arrived, he would bet big with conviction born from patience. That shift transformed him from a talented trader who kept going broke into one of the wealthiest speculators of his generation. Livermore's most famous quote captures this wisdom. "It never was my thinking that made the big money for me. It always was my sitting." He was not just talking about sitting in winning positions. He was talking about sitting in cash, watching, waiting, preserving capital and emotional energy for moments when odds were overwhelmingly favorable. Your complete protocol, the trading constitution. Here is your complete framework for buying dips correctly, the system that will save you more capital than any technical indicator. When RSI drops below 30, you do not buy. You watch. You move that stock from ignore to observation. You are now hunting for 3 specific confirmations. You wait for price to make a higher low, not just any bounce, but a retest that holds above the prior low, proving sellers have lost control. You wait for volume to dry up on that pullback. Light volume means seller exhaustion. The fuel for decline has been consumed. You wait for RSI to reclaim 40. This provides mathematical confirmation that momentum has shifted from bearish to bullish. If all 3 signals appear, you test a small position. Risk 1 to 2% of your account maximum. Calculate your stop first, then work backward to determine position size. Enter with conviction because you have evidence, not hope. If the stock proves itself by holding support and building momentum, you add to the position, pyramiding into strength. If it fails and hits your stop, you cut immediately. The small loss preserves capital for the next opportunity. If the 3 signals never appear, if the stock keeps making lower lows, or volume remains heavy, or RSI cannot reclaim 40, you do nothing. You watch it fall without you. You let it go. You accept this was not your trade. The ultimate truth about dip buying. Buying the dip correctly has nothing to do with catching the exact bottom. It has everything to do with surviving the bottoming process, so you have capital and conviction when the actual reversal begins. The amateur wants to be first. The professional wants to be right. The amateur wants to catch the falling knife. The professional waits for the knife to hit the ground, stop bouncing, and show signs that someone is picking it up carefully. When you see RSI below 30, remember, that number is not telling you to buy. It is telling you to pay attention. It is your alert that something significant is happening and you should prepare to act if and when your confirmations appear. But preparation is not action. Watching is not buying. Patience is not passivity. Patience is an active position that compounds value every time it prevents you from taking a bad trade. The money you save by not taking a bad setup is just as real as the money you make from a winning one. When you protect your capital during the chop, you have ammunition ready when the real trend begins. That is how you buy the dip correctly. Not by being brave when others are fearful, not by catching falling knives, but by waiting for confirmation that the fall has ended, entering with proper position sizing, managing risk ruthlessly, and having the discipline to do absolutely nothing when your setup is not present. Stop trying to catch the knife. Let it hit the floor. Let it stop vibrating. Let the dust settle. Then, and only then, do you pick it up with both hands and proper preparation. Master that patience, and you will have mastered the most profitable position in trading, the position of doing nothing until everything is right.